Xero Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Wednesday afternoon. I'm Juliette Sarli. Great to have your company. Let's have a look at where the local market has finished the day's session, and quite a nice rally, we will say, into the close there on the CBO 200. Similarly, seeing some impressive moves coming through on the ASX 200, up 66 points or 0.8%. 8,923 is where we are heading into match off. So lovely to see that 8,900 point level broken through once again. And of course, it's all thanks to this big move you're seeing in materials, in energy stocks, in financials. But not quite the same what we're seeing with the tech sector, is it? So let's get to the themes of the day. And it really was about this tech wreck, this concern about AI disruption, what it's going to mean for a lot of these software companies in the US, are all really driven, that catalyst, of course, on the Anthropic move there. We'll get further into that with Mark Gardner from MPC Markets coming up. But our tech sector, of course, not quite the same weighting as what you see in the US, but it's down by about 9%. That is not insignificant. Having a look at my market map, that big red piece on the ASX website certainly taking up a big chunk of the market map. But there has been that rotation into resources. We've got that pickup coming through in the gold price. Not a great reason as to why gold has picked up, though, with, of course, that attack on the Iranian drone by the US. The material sector up 3.6% as we head into the close. Energy stocks up by around 3%. And then, of course, reporting reckoning a lot of this as we focus in on these US names, but also as we kickstart a pretty busy time coming through from the Australian reporting season as well. And that will certainly ramp up a lot more next week. We heard from Amcor, though, today in terms of some of the big guns. What I want to show you, though, here is BHP and CBA, though. It really just seems to be this moving within the baton once again. BHP overtaking CBA as the most valuable company with that 4.5% gain of $52.41. But CBA is not taking it lying down, is it? It's got a 2.3% gain there, $156.64. A lot of focus on what it is going to deliver when it comes through with its earnings, and potentially we're just going to see this play out over the next month or so, or maybe even longer, the battle to the top out of these big two companies. Let's have a look at the tech wreck, though, and get a tech check. WiseTech down 11%, Xero down almost 16%, Tech One off by 11%, and Zip down by 9.5%. Energy stocks, though, I mentioned doing very well, but let's also check in on the gold players. As we saw this pickup coming back through in gold, Mark and I were chatting before we came in to the studio about how everybody is a precious metals expert, it seems, this week. We've gone from being defense experts to precious metals experts, but certainly a comeback in some of these beaten down stocks. Northern Star up 6%, Newmont up by 4.4%, Ramelius up by 5.2%. And that is a pick on quite a few people's radars, including David Lane from Ord Minnett, who really likes that stock. And have a look at the energy space here. Karoon up 2.5%. Ben Richards from Seneca really likes that stock. Coal miners also in focus. Prices surging after Indonesian miners halt exports there. Yancoal up by an impressive 8.5%. Whitehaven up 3%. There's Amcor as well. Now, it missed Wall Street estimates for second quarter sales, but the market has taken its earnings in a positive view. Amcor shares up by 3.3% on the close, listed here. Charter Hall also came through with some earnings. It upgraded its full year 26 guidance. The market didn't like it, though. And Jumbo Interactive down by 4.4%. Its preliminary results showing an underlying net profit after tax up 22%. But there has been, of course, fewer big lottery wins, and that's why it saw an increase in some of its earnings. There has been a little bit of a concern, though, about its outlook. All right, let's get to our guest, Mark Gardner from MPC Markets, joining me. Mark, I mean, you know, that 9% drop in IT, I know we don't have huge tech stocks, but it's a bit ugly.
It is pretty ugly, and I'm going to go out on a limb and say probably one of the best buying opportunities, I reckon, for this year.
Yeah.
There's nothing materially changed for any of these stocks. They're not AI stocks. They're not involved in chips or memory or any of the data center build out, etc. They're very solid, very high moat businesses, and Look, it looks scary at the moment, but I think we started dollar cost averaging. It was only last Friday, but I think we sold out of Newmont, but it feels this year's feeling very long. But we're certainly leading into earnings. I mean, Xero got 2 upgrades this morning. Consensus price target's over double. Macquarie's got a 220 price target on it. They're realistically, look, this looks like a global fund is obviously selling tech and rotating. In the US, it's trickled through. We lack liquidity here in Australia, and the tech sector's already beaten down and probably hit some stops today. But I do think it'd be one of those moments, where we look back in a couple of years and go, why weren't we backing the truck up? So. But at the moment, I think it's just easy, just dollar cost average as it stands at the minute, because you may get cheaper prices, but this is about as cheap on a forward PE and PE basis. You've been able to get all of those really high quality names for ages. And if you haven't had them in your portfolio before and you're starting to buy now, which we are, then you're probably pretty happy.
Yeah, I think you said to Andrew on Monday that you were getting out of gold into tech, so you played that correctly. What about, though, this big surge that we've seen, and I mentioned BHP? I mean, does BHP or CBA care who's the biggest on the market? But it certainly seems to be a big, look at that, 4.5%.
So $2 from all-time high, and iron ore's nowhere near it. So, and we've had quarterlies and Rio's at all-time highs. We've been, they're 2 of our bigger positions. BHP's our biggest. And we've had them all of last year and added to them over periods as well. Possibly just if iron ore starts to go, we might see it go even further. But I think different to last year where BHP was trailing CBA by a long way, now being top or top 2 is really going to be that passive support generally. So. Not as concerned, about it dropping away really fast. I mean, even it didn't drop away that much on that metals route on Monday, which was, the great bear market that lasted a whole day. Silver's, I just looked at just before we came on air. Gold's at 5,100. Silver's back at 87, 88. So, albeit that COMEX market is essentially now pretty much. It may as well be a crypto exchange. It's just a paper market now, so it's a bit of a joke actually, which is sad. But there's no real deliveries. They've upped margins ridiculously. I don't think it's a real reflection of where the underlying's actually trading anymore. But the silver miners are trading at close to 50-year lows versus where the silver price is. So. Whilst it was a scary start for that Global X ETF, it's largely recovered to be back within a couple of a percent from where it listed when silver was at the all-time highs.
Yeah.
So I think that's probably not a bad play. All
right, let's have a look at what we saw with the rate decision yesterday and where this goes. Quite a hawkish stance, I guess, here, and we might be in the start of a cycle.
Yeah, I think so. The way Michelle Bullock spelt it out was that there's probably 2 to go, at least, and if those transient inflation, or what they perceive to be transient inflation, doesn't come down, it could be more. So, she didn't give forward guidance, but she really did lay out a very simplistic maths about we don't see inflation coming down until the start of next year. It was private demand driven, not government, and it wasn't. You didn't have to be a genius to pick up the fact that one and done is definitely not going to be the case. I thought they might want to approach things a little bit, wait a little bit until the following month and see another inflation number. But they were really clear that they want to get inflation under control. And look, in the long run, your mortgage payments for younger Australians and the middle class, mortgage payments will bite, but in the long term, inflation is far more costly. It just does it in smaller bites, and getting inflation under control is, albeit that there's a bit of short-term pain on a mortgage payment, in the long term, that sector of the economy does a lot better over a 5 and 10 year period. So they are doing the right thing. It's just not very popular.
Well, it's not popular, but as somebody pointed out to me, like what the mortgage might go up by 100, 120 bucks, but yeah, every time you're paying and tapping at Coles and Woolies or wherever, and things are pricier, as you say, it hurts more. What does it mean though for consumer sentiment, for potential moves in consumer stocks?
I think they're getting extraordinarily cheap. I mean, you got JB Hi-Fi, I think, was down in the low 80s recently. And again, there's some, I probably won't be dipping our toe in the water just yet. Like Premier Investments, for instance, was there are a couple of market darlings that were trading at serious premiums, and now Premier Investments is trading at a sum of its parts plus smiggle, basically. So, I think. Obviously, you at the start of a cycle, you probably don't want to be jumping in there straight away. But I wouldn't be surprised if they surprise on the upside on earnings. But I think it's probably a bit risky to be buying prior, and then you don't want to. If it gaps higher, I don't think you want to be buying retail into a rate hike cycle. So we'll probably just sit on the sidelines there for the moment. But there's definitely starting to see some value, and I think overall we've had to deal with an expensive market for so long, and you're sort of getting pushed into FOMO probably in a lot of these tech stocks and a lot of these high quality retailers and things. And I think this year is going to be a big year of just stand back, take a breath, see the forest for the trees, and not and try to make decisions like on a 1 to 2 year basis in quality companies and high conviction.
Yeah.
Stay away from the marginal stuff. I just don't think you might get lucky, but you sure as hell might not get lucky as well. But I think it's a year to narrow your focus to the things you're happy to hold if they go badly, and dollar cost average, and look probably a year or two ahead, because as we've seen so far, what are we 6 weeks in? It feels like August or something already. So
it does. We haven't even really properly kicked off reporting season. Mark, thank you as always.
Thank you.
Mark Gardner from MPC Markets. Getting back to stock specifics, the stock of the day on the call was Pinnacle Investment, and it surged on record inflows, its acquisition of Pacific Asset. We discussed with our experts, Andrew Weiland from DP Wealth Advisory, Henry Jennings from Marcus Today.
I'm continuing to hold this one. I still like this one. I think it's a good business model. I like the PAM acquisition. That's the remaining 79.2%. These guys invest in fund managers. They're sort of a fund of funds. And I don't see anything wrong with these guys. They're smart guys. The guy that runs it, Ian Malone, has done a very good job, and I see nothing wrong with this. For me, it's a hold. As I say, I do hold it in my self-managed super fund, and I have no intention of selling it. But if by some miracle it got to $24 again, I'd be exiting stage left, pursued by a bear.
Probably the key thing we ought to think about with this, of course, Andrew, is that as long as the share market continues to hold around these levels, and there's some performance fees, then their managers, and therefore Pinnacle will achieve not only the underlying management fee, but some performance fees as well. Whereas if the share market does fall into a bit of a hole, then certainly anything that's equity focused, like these guys and girls, then they are going to come under some pressure. So as long as we're comfortable where the share markets are, then this is certainly a stronghold. And in fact, if it was to come under some pressure and they were to go back into sort of $12, $13 because the share market's tanked, this is one that you should have towards the top of your list in buying.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN, retirement income done differently. In a world of market noise and uncertainty, a disciplined approach to investing matters more than ever. Wealthy and Wise brings Team Invest's value investing playbook to Ausbiz. Unpack how the macro environment impacts business analysis. Put similar stocks head to head and make a call on which one wins.
Why would you want to put money in when the executives are taking it out or losing it?
Plus, ask Team Invest experts to deep dive into a stock or topic of your choice. Just email us your questions. Live from 1 p.m. every Wednesday. Wealthy and Wise is your guide to value investing, powered by Team Invest.
All right, let's get into the market leaders. On an update for the market, we touched on the coal players looking really good. Silex also having a good session, and of course a rebound coming through in these gold players too, led by Northern Star and Regis up almost 6.5%. To the downside though, today it was all about these tech players, or those that of course investors are a little bit concerned about the AI disruption. This was really sparked overnight by concerns for Anthropic's launch of a legal tool for its Claude AI chatbot. Xero down 16%. As Mark Gardner just told me though, this could be one of your best buying opportunities when you see stocks on sale like this. Let's have a look at the small end of town. Kicking it off with Altimony Industries, Terracom as well, and Mentos had a good day. To the downside though, we saw Cyclopharm off by 15.4%. Synlait Milk, there was an update there too. ReadyTech off by about 10%. Let's have a look at what we're expecting tonight, including inflation out of the Eurozone. We're also going to have the US ADP employment report, ISM services PMI, and earnings, of course, speaking about what we're going to see in terms of some of this tech wreck. Alphabet coming through with a quarterly. It fell overnight on Wall Street. We've also got Eli Lilly as we look at the disruption from these GLP-1 drugs, and Qualcomm as well. Tomorrow, locally, we have the goods trade balance, also the NAB quarterly business confidence, and Beach Energy is among those coming through with first half earnings. Let's recap where we are, and a very nice push into the close, up 0.6% on the CBO 200, while the ASX 200 has also recovered from a bit of wobbles at the beginning of the day. Wow, 70 points, 0.8%, 8,927, so comfortably back above that 8,900 point level. Virtually unchanged over the last 5 days, still about 2% from our all-time highs there on the ASX, and a 9% drop coming through in our IT sector today, but notwithstanding a 3.5% jump in materials and a 3% jump in energy. And for those who care, BHP is once again the most valuable company on the ASX. We'll see you tomorrow from 9:45 a.m. Eastern.